Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis welcoming you to Money Talk for the final time this week on Friday the 22nd of March. I have a wrap-up for you of the main business stories from across Asia in a week that's been dominated by central bank meetings. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the Bank of England held interest rates at 5.25% for the fifth meeting in a row as policymakers awaited clearer signals indicating that the country's persistent inflationary pressures had subsided. The BOE's Monetary Policy Committee voted by a majority of 8-1 to keep rates unchanged at their highest level since 2008. One member preferred to reduce them. Andrew Bailey, head of the BOE, says it's not yet time to cut rates, but things are moving in the right direction. The Central Bank of Taiwan unexpectedly increased its key benchmark discount rate by 12.5 basis points to 2% during its meeting Thursday. Economists had been expecting rates to be left unchanged, where they've been since March 2023. The rate hike was mainly influenced by persistent inflationary pressures. Taiwan's annual inflation rate surged to a one-year high of 3.08% in February, up from 1.8% the previous month. Australia and the UK have signed a defence and security agreement, deepening their ties in the face of rising Chinese power in the region. A new agreement makes it easier for their defence forces to operate together in each other's countries, and the new security pact was signed a day after Wang Yi, China's foreign minister, visited Canberra and called for stronger ties with Australia after 5 years of geopolitical tensions. Apple CEO Tim Cook said China is critical to its business in comments made during a visit to the country, where consumers are showing signs of souring on the company's iPhones and US technology. According to China Daily, Mr. Cook told the publication that there's no supply chain in the world that's more critical to us than China. On today's programme, I'm joined by Richard Harris, Chief Executive Officer at Port Shelter Investment Management, and Loic House, Chief Asia Economist at S&P Global Ratings. With a view from Australia is Toby Lawson, CEO at Statton Partners.
Peter Lewis's Money Talk.
On Wall Street, US stocks rose to fresh record highs on Tuesday amid a global equity rally powered by rising hopes that major central banks will deliver multiple interest rate cuts this year. The S&P 500 advanced 1/3% to end at an all-time high of 5,242. The Dow jumped 269 points, or 0.7%, to close at 39,781. The Nasdaq Composite edged up 0.2% to finish at 16,402, well off its best levels of the day, hit by a slide in Apple. Apple shares dropped 4.1%, the biggest decline since August 2023, after the Department of Justice sued Apple on Thursday, saying that its iPhone ecosystem is a monopoly that drove its astronomical valuation at the expense of consumers, developers and rival phone makers. Treasuries were mixed, with the short end lagging following a slew of hot US economic data, including below forecast jobless claims, a smaller fall than expected in the Philly Fed survey, strong existing home sales, and a mixed set of flash PMIs, which warned of inflationary pressures in the pipeline. The yield on the US 10-year Treasury fell 1 basis point to 4.27%. The yield on the more interest rate sensitive 2-year note rose 3 basis points to 4.64%, and traders are pricing in a 70% chance that the Fed begins cutting rates in June. That's according to the CME's FedWatch tool. The dollar rebounded, retracing all of the previous day's losses. The US dollar index rose 0.6% to above 104 as the Federal Reserve maintained its outlook for 3 interest rate cuts this year. Gold rose above $2,200 an ounce at one stage on Thursday and reached its highest levels on record. However, the gains evaporated later in the session and the precious metal settled 0.1% lower at $2,182 an ounce. Brent crude oil settled 0.2% lower at $85.78 per barrel. And the third net outflow in a row from Bitcoin ETFs sent the cryptocurrency lower. Bitcoin was down 1.6% on the day at $65,360. Mainland shares lagged as the PBOC injected the least amount of funds in its open market operations since August last year, despite the PBOC's deputy governor reaffirming that China's monetary policy has ample room and there's still scope for cutting the RRR. The Shanghai Composite shed 0.1% to close at 3,077. In Hong Kong, the Hang Seng that sold 320 points, or 1.9%, to end at 16,863 on Thursday, following small gains in the prior session. The Hang Seng Mainland Properties Index added 3.3%. The Tech Index rose 0.9%. Futures markets pointing to a slide at the open this morning for the Hang Seng of about 94 points, taking it to 16,770. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's the end of the week. The weekend is just around the corner. Let's welcome our gang of happy panellists this morning. We have with us Dr. Richard Harris, Chief Executive Officer at Port Shelter Investment Management. Morning, Richard.
Good morning to you.
And also with us is Louis Kuijs, who is Chief Asia Economist at S&P Global Ratings. Morning, Louis, to you.
Morning, Peter.
Central banks that oversee 40% of the world's GDP have been meeting this week. They include the US, the UK, Japan, Taiwan, Australia, Indonesia, Russia, Brazil, Turkey, Switzerland, Norway, and Mexico. There were some surprises. While the Fed kept this year's forecast for 3 rate cuts unchanged, it took off the table one of its rate cuts for next year and increased its economic growth forecast and inflation expectations for this year. Switzerland surprisingly cut rates, while Taiwan unexpectedly increased rates. Turkey sharply increased its base rate. Mexico cut theirs. The Bank of Japan ended its negative interest rate policy, also its yield curve control policy, and ended risky asset purchases such as stock ETFs. Richard, are we at an important inflection point for the global economy and for central banks' monetary policy, which is why we've been seeing wildly differing responses from the many central banks that have been meeting this week, including a few surprises?
Yes, I like the word inflection point. We do seem to be seeing a number of pivots in different places. For instance, in Japan, where is probably the most obvious one. But it is quite interesting. Since, say, late January, we've been in a position where we've seen some quite different moves in asset prices. We've seen the Chinese market start to recover slowly. We've seen India slightly come off. We've seen the US move ahead quite sharply on the AI story and the AI bubble, as I call it. We've seen gold start to move. We've seen oil start to move. So there's definitely something bubbling away behind the scenes, if you excuse the pun. And I think we are seeing the economy actually doing some interesting things that maybe we can't exactly predict what's happening at the moment.
Louis, what are your thoughts? It's been some wildly differing responses, haven't there, this week from the various central banks?
Yeah, wildly different responses, but I would say that I cannot speak on all of the countries you just mentioned, Peter. There are a lot of them, but thinking about the big one like US, Japan, I would say that. I would say in Japan I understand the move. In the US, I was a bit surprised. I personally think that looking at what inflation has done in recent months, it's not so easy to understand why the Fed didn't pick up on that and why they are so comfortable with their projection of 75 basis point cuts. My colleagues, though, who are more knowledgeable about this, my US colleagues tell me that, look, it's not that because it's clear that inflation is not yet under control in the US. But what my colleagues point out is that doesn't mean that you cannot start to consider to cut interest rates, because the current stance should be sufficiently restrictive. So even with a little bit less restrictive stance, you're still applying that withdrawal of stimulus in the economy. So that's apparently the story on the US. In Japan, I think it is great to see that the BOJ has the confidence in its own projections that inflation will not peter out and will continue to be somewhere, who knows, somewhere between 1.5% and 2% in the coming years, which is what their decision was based on.
Richard, some central banks seem to be getting less scared of inflation, though, aren't they? Such as, well, certainly the Swiss National Bank, which cut rates, but also maybe the Fed as well. And then others are still quite worried about inflation.
Well, I think there's a bit of behavioural issue in here. As inflation goes on, people are becoming more accustomed to it. After all, we had very little inflation for a very long time, and now all of a sudden we're looking at official levels of 3 or 4%, although those of us who actually do go out shopping realise it's a lot higher than that. So I think maybe there's a little bit more comfort with inflation being at these levels, with interest rate being at these levels, partly because we haven't seen any major failures as a result of higher interest rates. The economies seem to be able to take paying 4, 5, 6% interest rates at the moment, partly because they're doing quite well. And I think the central banks are probably quite happy just to be there, just to sit there, because it does mean at 4% type levels, they have room to maneuver. They have room, like the Swiss Central Bank or maybe the Bank of England, to cut a little bit, provide a little bit more stimulus, and also increase a little bit. And this is something that just wasn't available a few years ago when we had the zero interest rate policy.
Now, Louis, I'm wondering which of those central banks that we've been talking about this morning is the one that's maybe got the most predictive power. I'm thinking possibly the Swiss National Bank, because they are a G10 central bank. They're the first major central bank to start cutting interest rates. Are they maybe foreshadowing possible easing later this year by the Federal Reserve and the European Central Bank?
Yeah, possibly. Could well be. It's funny, right? Because it's only, I don't know, it's 6 weeks ago or so, 2 months ago, that people started to talk about, Australia and New Zealand possibly being the not canary in the coal mine, basically the central banks that will be the trend setters. And then people realized that in Australia, the economy is really not, it's not ripe for a rate cut. So maybe it is Switzerland. Who knows?
Yeah. What do you think, Richard?
Well, I mean, I think the thing is inflation is not dead. I think it's bubbling along below and probably quite strong in many Western markets. I mean, I was in my travels recently. You should never look at anecdotal evidence, but I'm going to. But you go into a UK supermarket and literally a month apart, prices have gone up. You do the same in Hong Kong and prices are pretty flat. And I think that's an anecdotal indication of the fact that inflation is bubbling along in the West. But we've got disinflation in the East. And what that's doing is that we're getting an average figure where the central banks feel they can pat themselves on their back and think the battle is won. Well, I don't think the battle's won, because if China starts to recover, we're now going to see not only more expensive goods being exported around the world, but we're also going to see more demand for commodities, more demand for oil. And we're likely to see an increase in inflation as a result of that. So I think we need to be very cautious that we're looking at static figures when, in fact, there are several narratives about inflation bubbling underneath.
So what do you think are the chances then that maybe the Fed actually just doesn't cut interest rates at all this year? There are some well-known economists who are saying that is a possibility.
No, it's just if you look at the dot plots, when people were forecasting recession towards the end of the year, all the dot plots sunk downwards. And if you look at them now, they've all gone back to where they were maybe 9 months ago. And I think that there is definitely a possibility that we may have no cuts at all. The thing is, at the moment, the buoyancy in the market is so strong that it may well actually take that on the nose and not look quite so badly at that as a scenario as they might do. At least rates aren't going up, and I think that's the view the market's going to take.
Louis?
I think Richard has basically given us two important points about your question, Peter. One is that, current interest rates in the US may not be so restrictive if you think that the neutral interest rate, which is kind of the interest rate that puts everything in equilibrium, it's not 2.5, what we used to think a few years ago, but as some people like Larry Summers argue, could well be, something like 4 or so, right? So then if you believe that, then the current monetary policy in the US is not that restrictive. And the second point is about there was another point that you were just mentioning that I agreed with, which is another argument why we shouldn't. Basically, the U.S. economy is still so strong in terms of there is a strong labor market. We see that domestic dynamics still powering inflation onwards, and then you don't really have any more a good argument to cut your interest rate. So I think that definitely in the US there is a good risk that we are going to be disappointed about the timing and the pace of interest rate cuts.
I felt,
and of course, the other issue is the US election down the road. How easy would it be for the Fed to cut or increase interest rates when you've got a very heated general election coming up?
Mm. I found it hard to reconcile what Jerome Powell said in his press conference and also the Fed said in its statement with what they actually did, because it was quite a bullish statement, wasn't it? It described the economy as growing at a solid pace. It said job growth remains strong. And it added this kicker as well, that warning that inflation has eased over the past year, but it still remains elevated. And then you reconcile with that, which then really was no change on 3 rate cuts for this year.
To ask the question back to you, would you have expected them, given their bullishness, to take away a rate cut?
Yes, I was thinking that maybe they might start edging down to perhaps 2. But in fact, what they did was they didn't take the rate cut away for this year, but they did take it away for next year. They were originally predicting 4 rate cuts next year. Now they're only predicting 3. So maybe they've just pushed it out a bit.
Yeah, maybe that's
kick the decision into the long grass.
Yeah. I mean, it's sort of, it doesn't really reconcile, does it? Because the economy is bubbling along quite nicely at the moment. And when they talk about a soft landing, I mean, look at that big upgrade to the Fed's forecast for real GDP this year. They're expecting growth of 2.1% compared to the 1.4% they forecast in December. I mean, Louis, that's quite a big upgrade, isn't it?
It's quite an upgrade. Of course, most of that upgrade is actually backward-looking because it was because of the very strong Q4 of last year, fourth quarter. But to me, the most intimidating data in the US is if you look at core inflation, which is what the central bank is also looking at, and if you look at how that is moving on a month-on-month basis, then we have seen an acceleration of inflation, not a deceleration, and that should intimidate anybody looking at this. So I think the way that my colleagues put it is that the balance of risks, because they also still project 3 rate cuts, but they in their words, the balance of risks has moved to fewer cuts.
Mm. I mean, Richard, they've taken out one of the rate cuts for next year, but they're sort of, they're saying that basically their risk to their inflation forecast is to the upside, but they still see 3 rate cuts this year. Although I did notice that when you look at those dot plots, a minority of the 19 members, or 9 of them, in fact, so a substantial minority, do see the Fed cutting fewer than 3 times this year. So maybe behind the scenes, that might come to hit us and they might actually revise down those dot plots.
Well, I mean, I can't get the overwhelming impression that the Fed actually really wants to do almost nothing. The biggest risk to the Fed, they think, is of doing something that's wrong. And being caught out. So, they made a decision to increase rates, and they did it quite significantly, but it took a very long time to do it, far, far, far too long. And you can't get over the impression that, they're looking through the rearview mirror with binoculars and taking data from them when they should be actually looking forward and trying to make some forward estimates of what the market's likely to do, not sort of look backwards and be data dependent. I think this has been a continual failure of this Fed, has been a failure to really keep up with events and always to be surprised. And if possible, to do almost nothing. So, we have this issue of let's have greater transparency, but at the same time, there's also a real desire to do as absolute little at all as possible in case we might get blamed. So it is difficult to see where the leadership is really coming from. And as Louis says, there is some. It's not distinct really about whether they're actually going to go in the direction that they're actually saying they are.
I mean, Louis, maybe he's trying to get across. Jerome Powell's trying to get across two messages here. Is indicating, wants to indicate the Fed is open to cutting rates, but at the same time, trying to manage expectations, particularly about when that might happen, and perhaps is sort of getting caught in the middle somewhere.
Yeah, I mean, I think that's right. I don't want to be in this place. It must be a very hard job. But I totally understand those advisors or people who say that, look, since they were late they kind of missed the boat in terms of being too slow in hiking them. It is in their interest to err on the side of keeping them higher. They don't want to again be in the history books as having been too complacent on inflation, and so they should err on the side of higher, I would argue.
Richard, one thing that Jerome Powell maybe didn't address at all, although he perhaps had a chance to do so, was to talk down some of these rallies in risk assets that we're seeing. In fact, he didn't really even acknowledge that, in line with what perhaps Louis was saying earlier, that financial conditions are easing as a result of these rallies, and maybe conditions aren't as restrictive as the Fed likes to make us believe.
Well, I think that's certainly the case. If you have buoyant inflation still ticking along there, you have really quite a hot market. Earnings increasing, which is pushing markets up. We're at all-time highs. I mean, we're in a situation where happy days are here again. So I just have the feeling that there is a real disconnect with the Fed, with what's happening in the real markets. And when they do appreciate what's going on, it's too late. I've always had a general concern about central banks is that, with due respect, Louis, they tend to be run by economists who do look at facts and data as opposed to looking ahead as maybe, dare I say, an investment banker or investment manager would, and sort of say, well, what's going to happen in the future? And if we're going to do it here, I think, my map for the future would probably be that we're going to get maybe one or two cuts this year, just because they've said they've done it, providing the macro stays the same. And then the election comes along and there'll be nothing. And obviously post-election, it's anybody's guess about what's likely to happen. We may well get that heralded recession. There's no reason why some of the trigger factors, some of the negative issues may not come through then as a result of the election stirring up the pot. So I think it's really, as you say, Louis, it is very difficult for the Fed, but I don't really feel that they're using all the tools that they might be able to.
I mean, I need to, of course, disagree with Richard in terms of what economists do. I mean, the people that run central banks are supposed to base their decision on their forward-looking view, right? And that's why they have models and do predictions and stuff. It's just that I think sometimes they get things wrong technically, and there is a lot of herd mentality. I still remember in 2021 when inflation started to really pick up, but they were all trying to talk it away. And then until suddenly they realized this is ridiculous, we have to acknowledge where we have inflation. So that herd thinking is a problem, which is why it's kind of interesting at the moment that we get those opposite moves. So maybe that's helpful.
Yes, why should we have 19 dots on the dot plots? Why not 17? Why not 22? Why not 8? 19 does sound like rather a lot of people who are making estimates about the future.
Yeah.
In fact, we probably should have 100, and then we could maybe draw a normal curve.
We could add hours.
Yeah, that's right. Maybe that's something for the future, Peter.
Yeah.
Peter Lewis, dot plot.
Dotplots.com. Louis, tell me a bit about the Bank of Japan. In fact, we got a bit of an update on the Bank of Japan because their inflation numbers have just come out. Japan's headline inflation rate for February came in at 2.8%, climbing from the 2.2% seen in February. Core inflation, which strips out prices of fresh food, also came in at 2.8%. That compares with 2% in the previous month. And that data this morning has sent the Nikkei 225 to a new all-time high, above 41,000. Will the Bank of Japan be pleased to see this?
Yes, I think so, because what they really want to see, and that what they have been trying to communicate, is that they say, we know that there's inflation now. It was driven by cost push factors initially. What we want to see is a nice spiral between wages going up and prices going up, where firms have the confidence that they can raise their prices finally after decades, and where workers have the confidence to ask for more wage increases. And of course, we know, everybody has read about how in the negotiations with large employers, we have seen very nice wage increases of 5.3% last week. What the central bank hopes to see is that all these people, the vast majority that work for smaller companies, will also get a decent wage increase, and that we will start to get some of that helpful interaction between higher prices and more wages. That will allow inflation to, stabilize somewhere between 1.5% and 2%, and that would then give the central bank the confidence to raise its interest rates without that, having dramatic impacts on things like, the government's fiscal arithmetic and corporate.
Richard, do you think we're seeing that virtuous circle that Louis just described there, and that we know the Bank of Japan wants to see, whereby you get rising wages and then higher prices, and that in turn boosts domestic consumption, fuels inflation, and so it goes on?
Well, we had pretty well 30 years of a vicious circle. When I can remember going back when Japan was the last time high. There were the triple merits in Japan. You had low inflation, low interest rates, and high growth, and that flipped pretty quickly around 30 years ago. We're at the all-time high, and Japan just went into this slough of despond with some terrible performance for a long time. All of that now seems to be catching up, and we do seem to be having a new Japan. I can't help thinking, though, that the triple merits, which held as a market mantra for a very long time and kept the yen extremely strong, at times when I couldn't work out why all the factors seemed to go for a weak yen, they kept the yen strong. And in recent years, of course, we've seen the yen weaken significantly, almost a half of what it was against the US dollar. And I think that has actually, in terms of fundamental economics, changed a lot of the metrics. And that also seems to come at a time when many of the companies are thinking more about profitability, about social changes in business, and coming out of the kind of the waxy fixation that the Japanese economy was in. So it's too early to say, have things changed dramatically, but there certainly does seem to be a pivot happening. And the market is saying that in terms of its extreme rise in the last 12 months or so.
Slightly counterintuitive, isn't it? But every time the Bank of Japan raises rates and the more inflation goes up, the more the yen seems to weaken.
Yes, it is. And but I can't help thinking that, this is also, markets are all about history, and what happens today in markets are often reflected by what happened yesterday. And the yen was very, very strong for no particular reason for decades. And now maybe we're just seeing the pendulum effect of that, of the yen just being weak because there's a general feeling in the market that that's the direction it still needs to be going in.
Do you think, Louis,
I think there's one issue, Peter, with regard to the yen. If you try to understand the link between the Bank of Japan's policy and the yen, it's really hard because that policy is only moving by very small amounts, right? I think the changes in expectations of what the Fed will eventually end up doing have been a larger factor than the Japanese side.
And we've still got that very wide, regardless of what the Bank of Japan's doing, we've got that wide yield differential between US rates and Japanese rates. That's still there, isn't it? And it's going to be there for a while.
That's right. And anything that the Bank of Japan is doing is not having a major impact.
Do you think that vicious circle that Richard was describing that Japan used to be in has now been taken over by China? Is China now in that same vicious circle?
I personally don't think so. I think that China. There are some similarities between Japan then and China now. One big difference is that China is at a much lower stage of development. Whatever you say about China, it is still going to not be so difficult to grow at 4 or 5%. And it is going to be easier to generate some inflation in your economy. We've seen a lot of, we've seen weak inflation data recently, mainly because of very low pork prices in China. But services prices have continued to increase, and that helps core inflation. I'm not so worried about, I think China has issues with overcapacity in various goods markets, but the services price inflation will prevent, a negative spiral between wages and prices.
And that overcapacity means it's got to rely on exports more, which is going to be problematic at the moment, I think, isn't it?
Yeah, it would be better if they don't rely too much on exports, because it's not, it's not anymore only US and Europe. It is also Brazil, India, many other countries that are starting to be vocal about this. So China needs to watch out.
Richard, tell me. Sorry, carry on, Richard.
No, you can, Peter.
I was going to ask you for your thoughts about the markets. I mean, we're seeing a global rally in all sorts of things, really, aren't we? In stocks around the world, certainly in the US, in gold, in Bitcoin, all hitting new all-time highs. There seems to be a lot of liquidity around pouring into risk assets at the moment.
Well, that's right. I think, we're still seeing the rump of the liquidity, the huge liquidity that was created not only during COVID, but also in periods before that when, every time the market had a wobble, Bernanke would cut rates. So we've had the generation of increased money supply that's just continued through, and sometime it has to stop. But I think what we've had recently is a continuation of the momentum of this liquidity drive that's kept markets going. Markets really depend on confidence. And the consumer, especially in the West, is very confident. One of the key metrics I was looking for this year is where unemployment was going. Well, unemployment continues to perform very well, i.e. Many people are employed. And those that aren't employed actually have quite a lot of money. If you're looking at Western markets, a lot of the people who are, should we say, unemployed or underemployed are those getting more elderly who have reasonably decent pension schemes. So there is a lot of liquidity around, and I think there's momentum driven on that, and people are less worried in general about the rise in interest rates. It doesn't really affect everybody as much as, say, it would in the 60s. It tends to affect young people who are building their careers, who don't have an awful lot of money. So there is a difficult group out there, I think, in the markets, but there's also a lot of people who don't have to worry about interest rates, and that's keeping things going.
Louis, where do you think all this liquidity is coming from? Is there a lot of savings out there? I mean, I suppose it depends which country you look at, doesn't it? I mean, we know certainly the Japanese have a lot of savings. I'm not sure Americans do, but they've got their credit cards, I suppose, to max out on. But there is a lot of liquidity around, isn't there?
Liquidity is one of these magic words, right? If you ask 5 people what liquidity really means and how you measure it, I think you'll get 5 different answers. One thing we know is that, of course, in a lot of Western countries, a lot of people got money on their bank account, often from the government. They couldn't spend it, so we had these excess saving balances on people's bank accounts that they have, slowly started to deplete. In the West, we've seen more interest rate increases, tighter monetary policy. I guess some of the liquidity is coming from those amazing market developments where people see their financial wealth increase. So it's a little magical.
It is becoming a little bit more discerning, though, in the US markets, isn't it? We had the Magnificent Seven, which were really accounting for all of the gains in the S&P 500. It now seems to be the terrific two, just Nvidia and Meta, that are going up, and the others have been pretty well in the doldrums. But what do you think about US markets?
We have seen this bifurcation, if you like, of markets for quite a long time. I mean, the Magnificent Seven have been rolling on and moving up, and you wanted to be invested there. But they have been pulling up the rest of the market as well. So we've seen some significant moves, Nvidia up, say, 3 times, but that's also pulling up the rest of the market. So I'm not sure whether we should be so concerned about the narrowness we've seen there. It's something that's just been going on for the last 5 or 6 years. So I think really what's happening is we're in a stage of momentum at the moment where people are feeling bullish. The consumers feeling bullish, management are feeling bullish because the earnings are coming in. AI is making people feel bullish, and we've got this general momentum going on that's moving things forward. Therein lies, of course, a danger because, what happens when the music stops? Now, that's going to depend on some event, which could be a geopolitical event. It could be the general election in the US. It could be a variety of other things because it's always events that stop these parties. But at the moment, my guess is it's going to keep rolling on probably for another 2 quarters.
Louis, do you see any economic events that could bring this party to a shuddering halt?
Not so much a shuddering halt, because, as you said, we expect, if you look at it, things on a quarter-on-quarter basis, at S&P Global Ratings, we expect the U.S. economy to slow this year, but we're not looking at a crash or so. So it is still a soft landing that we are all looking at. In Europe, there's no growth, but we also don't really expect the economy to crash further. So it's still, on the economic side, a relatively benign scenario. I guess on the economic side, one issue that could put a spanner in could be that inflation is really not coming down; it's actually taking off again.
There's an important point that markets adapt very well, and as new information comes in, markets adapt, and markets go up and markets go down. If we have a crash, that's an indication that something's happened that markets cannot adapt. And that actually happens fairly rarely. So I'd probably go with Louis at the moment, that we're likely to see the markets carry on as they are and be fairly sustainable. But there may well come some event at some time that the markets cannot adapt to, and that's where you could see a significant fall. But like Louis, I don't really see that happening, except possibly for the US election.
Okay, well, great to hear your thoughts. Thank you very much there, and have a good weekend. That was Dr. Richard Harris, Chief Executive Officer at Port Shelter Investment Management, and Louis Kels, who's Chief Asia Economist at S&P Global Ratings.
Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Good morning, Peter.
Now, Chinese Foreign Minister Wang Yi was in Australia this week, met with his counterpart Penny Wong in Canberra, and also met with Prime Minister Anthony Albanese. Did he come away with his wish list intact?
I don't think so. I don't think there was any particular pluses or minuses out of the trip, apart from the fact that Prime Minister was in Australia and was well met. And, one of the topics of discussion, particularly around trade, the releasing of some of the restrictions in relation to wine and other products that were banned, or at least tariffs were imposed at a significant level in the last few years as the relationship between Australia and China waned somewhat. So I think in that sense it's a reset, which is quite good, but nothing too constructive came out of it. But I think what was the most interesting thing, Peter, was that the Chinese Prime Minister met with a former Prime Minister, Paul Keating, who has been quite vocal in his support of Beijing and quite critical of the Labor government and the previous coalition government in relation to how they've dealt with China and how we've pivoted in Australia more towards the US and the UK. So That was a significant piece in the public relations aspect of the visit. So, but from a purely economic perspective, from a markets perspective, nothing too much to take out of it.
And how did that go down, the meeting with Paul Keating? How was that received in Australia amongst the public in general, or is it not something that they were particularly bothered about?
I don't think on whole. I think those who are interested in politics and those interested at that level would have taken quite a keen interest and probably had a mixed view in relation to its value. Probably more of the government was not happy about it, but they were very clear that they weren't happy and that the former Prime Minister doesn't speak for the government. But more broadly, it's not a huge news item in Australia, but it was well noted in the leading press that this happened. But the conversation has no real impact on government policy. It was more just a public relations exercise for Beijing to get some value, because the former Prime Minister Keating has been a very strong supporter and vocal supporter of Beijing.
You would think that trade will be a win-win for both sides, because surely both sides want to do more trade, and it's really down to China, isn't it? I mean, they're the ones who slap the bans on wheat and barley and wine and so on. They describe the relationship as having some twists and turns. I suppose that is their euphemism for some these trade difficulties. But you would think it would be an easy one to fix.
Yes, but it's tied up in a much more complex geopolitical discussion, with Australia being, a key ally of the United States. The nature of the relationship between Australia and the States in this region, where the US wants to play a key role, and Australia is probably the key ally in the region of the United States, along with Japan. So, of course, it's got very little to do with economics and the logic of doing trade together, to be honest. And Australia, unfortunately, fortunately or unfortunately, is fortunate to have a market the size of China in the region, but obviously we're bound by their decision-making more than ours. So it makes it a very tricky, complex relationship. But I think overall, both sides want to make it work, but neither are going to cede political ground. And I think Australia is quite strong on that it's not prepared to bend its political views for the benefit of trade.
Yeah, and Wang Yi wanted some of these relations that Australia and New Zealand have with Western allies in AUKUS and the Five Eyes to sort of tone them down a bit and maybe not develop those types of relationships. But that's simply not going to happen, is it? Australia and New Zealand are both going to do that.
Well, I think New Zealand's a bit less, a bit more sanguine, if you will, because New Zealand's always had a bit of a more fractious relationship with the United States than we have historically, but it's still a very strong one. So I think New Zealand was a bit balking, because AUKUS, New Zealand aren't in AUKUS, which is the Australia, UK and US military alignment. So I think in that sense, New Zealand's potentially still one that China might be trying to push or influence a bit more. But I think Australia's been quite clear that we're not going to, drift away from that relationship with our allies purely on basis of trade restrictions.
Now, let's turn our attention to central banks. It's been a big week, isn't it, for central banks? Central banks representing 40% of world's GDP have met this week. A few surprises among it. What about the Reserve Bank of Australia? They left rates on hold at a 12-year high. Was that a surprise or in line with expectations?
It was in line with expectations, but interesting in Australia. I think the last time we spoke about, when the previous meeting of the central bank, that they were ruling neither in or out rate rises or rate cuts. And I guess nothing really changed in the language, apart from suggesting probably the balance has shifted to lower rates rather than any higher rates. So a neutral stance to slightly dovish might be the reaction. What was interesting, Peter, that the next day the labour force figures came out in Australia and were extremely strong. So the unemployment rate went from 4.1% to 3.7%, and more than 100,000 jobs created in the month. And that was a huge surprise. And that possibly, not to say that the Reserve Bank had a pre-read on those numbers, but one of the concerns they have is, inflation still well above the target range, and the tight labour markets have have an influence to suggest that we might not see rate cuts sooner than what the market would hope for. So that was quite an interesting release yesterday, and sort of pretty much affirmed the view that the RBA will take as long as it can before it moves to lower rates.
But there are others that are cutting rates, like the Swiss National Bank, so they seem to be less afraid of inflation at the moment. And maybe what about the Fed? Where do they stand? Are they sort of moving towards cutting rates, albeit at a very slow pace, or are they a little bit reluctant?
I thought Powell was a bit more optimistic than I think the market was in relation to the 3 cuts in this year. I think he was quite confident that they could achieve that goal, even though some of the monthly data we've seen has been sort of seeing inflation spike up a little bit from where it was. So I thought they were quite optimistic, and you can see the equity markets were very happy with the comments from the Fed. But I have seen in subsequent reading around that there are a number of players who think that it's going to be difficult for them to cut rates this year. So I guess the way in which you want to look at it is, are they saying that they're going to cut rates because they think the economy is slowing more aggressively and hence they're going to need to provide some stimulus? Alternatively, are they seeing that the inflation is going to continue to come down? And I think it's probably Powell's comments were more related to the latter rather than the former. And that was very positive for equity markets.
It seems hard to reconcile what Jerome Powell said with what they've done, really, because the Fed revised up very sharply its growth forecast for this year. It also revised up its inflation forecast, but left unchanged its projection of 3 rate cuts. The two don't really go together, do they?
Well, that's yes. So clearly, I think that it was a bit of a surprise that the language was as dovish as it was reported and as it was quoted from the statement from Powell. So yes, it is hard to reconcile in that sense, but the market was happy because I think they saw on balance that the reason that they think they can raise the cut rates this year is because inflation will be down as opposed to growth stalling and any threat of recession. And so I guess on balance, whilst it's difficult to reconcile, it's a positive outcome for markets if it's an inflation story rather than a growth story.
I mean, it sort of makes you wonder how serious the Fed is about getting inflation to 2%, because they seem to be saying they're willing to risk cutting rates before inflation is close to that target. And while GDP growth is still above trend, that's always been a risky path for central banks to follow, hasn't it?
Yeah, and I think the language has been pretty consistent on that basis, and so it was slightly surprising that that he expressed confidence that they would be able to do 3 cuts this year. Having said that, US rates are at 5.25, relatively high, and I think the UK is the other one with slightly higher base benchmark rate. So it's possible that even 75 basis points of cut in the US doesn't necessarily suggest too much accommodation, because if you look at European rates and other central bank rates, they're probably in the 4 handle rather than the 5 handle. So maybe in that sense, the Fed feel they've got a little bit more room to move. What
about the Bank of Japan? They're moving in the other direction, albeit very, very small steps, isn't it? Just a 0.1% increase, but I suppose very significant and symbolic in some ways.
Incredible, isn't it? 17 years. Since they've raised rates. It's quite extraordinary. And yes, albeit from minus 0.1 to 0 to plus 0.1 is hardly noticeable, but it's significant in terms of its historic precedent. I think the thing that Japan was the Bank of Japan were looking at was that we've now seen wages move in, which is something that's rarely happened in Japan over the last 20 years. It was, I think, a 5.25% increase in wages across the board with large corporates. That gave the signal that they needed to probably tighten policy to reflect the changes in dynamics in the labour market in Japan. So but a long way to go before. The other aspect, of course, is they lifted the yield curve control, So at the long end, you'll start to see some more movement in the bond market. But overall, I think it's a good sign for the Japanese economy.
Now, and the Japanese market's like this. We had some inflation data out this morning, which shows both core and headline inflation moving up further. The Nikkei is now above 41,000, the new all-time high. The more inflation goes up, the more the Bank of Japan seems to raise rates, the more the yen goes down and stocks go up to new highs.
Well, it's a dynamic that's it's taken a long time. So there's a lot of enthusiasm around this scenario, and a bit of inflation is what Japan needs. It needs to create that escape velocity, if you will. It has been running in a very sort of disinflationary environment for such a long time that they'll take a risk to the high side on inflation right now versus trying to temper that. Now, be careful what you wish for. As we know, with inflation, it's hard to control, but Japan's coming off a really low base, so I think they'll be comfortable to see that, and the markets are reflecting that in their pricing.
And finally, what about in the US? The rally just keeps on going. We talked about this last week, but it's still going, isn't it? More all-time highs, all three major indices there. They seem to like what the Fed is doing and what they're seeing.
Yeah, and as we discussed, I think they were particularly happy with the tone of Fed Powell's comments that that despite the fact that the economy is still performing well and the GDP is going to be revised upwards, they're seeing inflation coming down. Wouldn't quite say it's Goldilocks, but the idea that the US economy is about to fall off the cliff and they're going to have to cut rates to promote growth doesn't seem to be the case. So equity markets are very, very comfortable at the moment. Now, a lot of it, again, you've got to look at a little deeper in terms of what stocks are driving the rally. We're obviously strong in the tech and the AI stocks are adding significant aspect to it. But overall, I think the mood's pretty strong in the US.
Toby, thank you very much indeed. Have a great weekend. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and Simon Kavanagh, Partner at BDA Partners. Providing a view from mainland China will be Hao Hong, Chief Economist at Grow Investment Group. Have a great weekend.
Money Talk.